Good morning. This is Campbell McCrary here at Amvest Capital in New York City. Welcome to the Amvest Capital Inc. live webinar with InPlay Oil Corp. InPlay trades on the TSX as IPO and on the OTC as IPOOF. Do hope you'll enjoy today's program. It will also be available in replay mode. Do feel free to chat in your questions. Just use the question pane of the GoToWebinar control panel or email them in. And we'll ask the questions in real time. So anything you have about the company or the market, especially market trends. Amvest Capital is a New York-based specialist investment management and corporate finance firm focused solely on the natural resource sector. And the all-important disclaimer, this call is for informational purposes only. Very pleased to have with us today Doug Bartoli, making you presenter, Doug, and share your webcam. He's the president and CEO of InPlay. He was previously a founder, president, and CEO of Vero Energy from 2005 to 2012, a very successful name, and was also VP of operations at True Energy, and had management and engineering roles at Husky Energy, Inc., Renaissance Energy, and Pan Canadian Petroleum. So a very successful resource career. Again, following the presentation, we'll be asking questions. Please send in your questions. We'd love to give them to Doug. So welcome, Doug.
Thanks, Campbell. Thank you for that introduction.
Everything's working here, so I'll let you know if it doesn't.
The right screen's on there?
Yeah.
Okay, awesome. Well, thanks, Campbell, for that introduction. It's a pleasure to be here today and to present to everybody. This is our first webcast since we released our year-end results, which was specifically highlighted by record reserves across the board, which is a feat within itself. I'm going to talk about our technical team and how it's provided these top-tier capital efficiencies and how important that is going forward. I'm going to talk about how we managed through the pandemic of 2020 and the demand destruction it caused and the harm it caused the industry and how we survived it. And basically, I think how we actually are coming out of the back end of this better than potentially we were in the front end. So again, really excited to talk to you. Scott Koich is on the line here today. He's our investor relations manager. All of his information is on the back of the presentation here as well. And then, of course, all of our disclosures in the back of the presentation. So feel free to read through all of that at your leisure. With that said, let's jump into the presentation and get into the investment highlights. So sorry, Dave. Actually, I want to get rid of that. So we're a technically focused management team operating in a sustainable light oil company in a very challenging environment. We've been showing top-tier production growth within our adjusted funds flow for basically since inception when we went public in 2016. We're positioned in two of the most exciting plays in the Western Canadian Sedimentary Basin, being the bioturbated Cardium light oil play. That's our main play. That's where most of our capital is going towards. That's where our growth is coming from, and that's where we're really, really efficient right now. Then we got a long-term play in the East Basin Duvernay. We've been consistently delivering top-tier production growth since our inception. You can see the great growth in 17, in 18, in 19 over 18 and 18 over 17. And then, of course, 2020 was a difficult year, but we're back to forecasting a return to that top-tier growth within our adjusted funds flow. Our guidance of 51 to 5,400 BOEs a day, it exceeds our 2019 average production guidance of 5,000 BOEs a day. That provides us with about 28 to 35% growth over 2020 and 2 to 8% growth over those pre-COVID levels in 2019. We're forecasting a record year of funds flow. I mean, massive growth, 420% plus over 2020, but 20 to 29% over 2019. Again, so potentially a record year all around for us. Generating free adjusted funds flow in our current forecast of somewhere between 15 and 18 million. And that's at this point in time to be used to repay debt and get us back to those pre-COVID levels. We're an operationally and technically strong, expert team. We've got a high quality asset base that delivers top quartile capital efficiencies. And to me, this is a key piece that has changed in the oil and gas industry, and you need to have this going forward to survive and to be at the top of your game. We found our barrels, our proved developed producing barrels of reserves for under $10 per BOE. We're adding producing barrels at a BOE a day basis for under 20,000. We've been doing that consistently since inception. All of these are keys going forward. We weathered the COVID storm. We halted all our capital spending. We identified wells that were losing money due to the low pricing. We shut them in, we curtailed production. We implemented massive cost-cutting structures right away. But in Q3, Q4, we got back to business. We first on the list was getting liquidity and sustainability, and we did that by getting a $25 million second lien term facility from the Business Development Bank of Canada, 4-year term, great piece of business. With that, we got our sustainability and our liquidity. We started workovers, bringing on curtailed production right away. We resumed the capital program, drilling 3 wells that came on right at the end of 2020. We were actually able to do an accretive low-cost tuck-in acquisition in our core area, and I think we're in a very strong position to do some more now. That was done at a cost fraction of what it would take to drill wells. We're better than ever. We're back better than ever. We had record reserves ending 2020, which is extraordinary considering the challenges we had in that year, and many of our peers were unable to do that. We had a significant growth in that environment. Our NAV on a very conservative price deck from reserve evaluators is on a proved developed producing basis $1.02, just under $2 on a proven basis, and $3.50 on a proved plus probable basis. So again, lots of potential upside here. So we are actively executing on our recovery plan, and we're doing measured growth, and we're getting lots of free funds flow, which is important in this environment, and we're using that, as we said, to repay debt. Quickly, our corporate's overview. Average production of 51 to 5,400 BOEs a day we talked about. Drilling about 8 horizontal wells this year. Record reserves on a proved plus probable basis. You can see our basic shares outstanding, fully diluted. Market capitalization is around 40 million Canadian with an enterprise value of 114 million dollars. Decent liquidity in the last 6 months. At times it's more active than others, but solid daily activity there. Employees and directors own about 8.3%, and about 28% are owned by some large insider shareholders. So at the end of the year, we were drawing 63.8 million with a net debt of just under 74 million on credit facilities of 90 million dollars. And we're going to be lowering our draws as we go through 2021. So again, decent position there. We're a very strong technical team, value creators. Same with our board. They've been experienced, industry savvy board. All of the information is in the back of this presentation. It's in our website if you want to view that anymore. And 2 of those members are on that shareholder list of major insider shareholders. 2 of those board members that own about 28% of us. So feel free to read that at your leisure. So the production chart on the left, that's one of my favorite charts. The green is light oil. The orange is natural gas. That's our growth since we went public in late 2016. Strong growth year over year, except of course in 2020, which was, as we all know, a pretty difficult year. The blue boxes is our growth per share. If you are growing on a per share basis over time on reserves and production, you should be creating long-term value. And that's why it sets us up very nicely as the commodity prices have improved here. Reserves on the right side. Since inception, we've grown every year, every category of reserves, proved developed producing, proven reserves, proved plus probable, 33 to 34% through those categories of reserve growth. What was phenomenal was our growth in 2020 over 19, PDP plus 11%, total proved plus 16%, and total proved plus probable plus 20%. Exceptional considering the environment we're in. We're going to focus on those reserves a little bit more because the reserves are the backbones of the company and what provides us with long-term value. But let's look at those highlights. Proved developed producing reserves. That's basically our blowdown case. So that's just if our proved reserves are blowed right down. We replaced our reserves there by 166% year over year. We have one of the highest reserve life index amongst our light oil peers of over 6 years. Total proved, we replaced our reserves over 300% with a 15-year reserve life indexed. Total proved plus probable, we replaced 479% of our reserves with a 22+ year reserve life index. These are huge numbers when you take a look at it. So on a proved category, that's about a P50 case when you start adding a P90 case, probably 90% happening when you add about new drills. And a proved plus probable is a P50 case when you continue to add more new drills, just to understand that. Let's look at the finding costs here. Under $10 for proved developed producing reserves, under $6 for proven reserves, and $8 for proved plus probable. We took some peers that we've taken out of their reports, and this is the average of our oily peer group. Again, we're at the top of that peer group, which we'll talk about on the next page here a bit. This is just as how we sit with our peers. We've been providing top tier efficiencies, finding reserves and adding producing barrels for years now. You can see on a proved plus probable basis, we are at the top of the group. On a proved, total proved basis, again, we're at the top of the group, and we're second on a proved plus probable basis. You know, the funny part is we left some blanks here. Last year, there was 9 of us in our group. 2 of those companies have sold, and 3 of those companies did not report finding and development costs because they were basically extremely high, or even you couldn't even account for them due to the difficulties that were in 2020. So again, very, very phenomenal piece of business we've been able to do here and to come out of the back end of this. So our environmental leadership. You can see in the top chart in the left corner, our greenhouse gas emissions have been dropping every year. Of course, a little less drop in 2020 over 2019, and that's specifically due to the fact that we curtailed production and we had less production to reduce emissions by. A couple of little pieces are we've obtained about 1.8 million in a program from the government to go against decommission liability. We've been working on that continually. 3 to 4% of our funds flow goes on a yearly basis to reducing ARO liability. We started a new program. It allows us for spending in a focused area. First year at it, but there's a lot of guys that are saying they're getting up to 40% cost savings by doing this. So if we get those cost savings, we're going to be able to decommission a lot more entities with the current 3 to 4% spend. So where do we operate? We're our head office is based in Calgary, Alberta. Our main field, whereas 90% of our production is the Cardium, so that's Pembina and Williston Green. That's about a 2.5-hour drive northwest of Calgary. The Duvernay is about an hour and a half northeast of Calgary. You can see our mid-range of our guidance here is our production levels. We're already at pre-COVID 2019 production levels in the first quarter. So that's above 5,000 BOEs a day was our average in 19. Again, very few of our peers can say that. How do we get this capital efficiencies and these growth? And it's quite simple. We have a low decline light oil weighted production. We have high netbacks, quick economic payouts, and that decline is showed right here from our reserve report. This is our PDP reserves decline in year 1 and year 2, right from our reserve report. When you take a look at our operating income margin on the right, you take a look at the purple columns. Every year, we've been able to increase our operating income profit margin, and we got it plotted on the right-hand side with the blue squares against WTI pricing. So we were up over 50% the last few years. Of course, with WTI less than $40 average in 2020, it dropped significantly, but still not bad at 40%. But with our cost-cutting measures and everything that occurred in 20, we expect to be over 60% profit margins in 2021, and that's including WTI at just about $60 or just slightly over $60 WTI for the year. So again, every business, I don't care what you are, you want to keep increasing your profit margins, and we've been able to do that. Williston Green. In yellow on the map on the left here, this is our land base. All the green dots are old vertical wells. You can see where we've been drilling horizontal wells, accessing pay that was not accessed with the vertical well bores. We've drilled a lot of wells here. We are drilling extended reach wells 1+ miles, but normally 1.5 miles our favorite length. We're pace setting these wells. We're drilling the fastest wells. We've been exceeding our production forecasts. When you take a look at the economics here, just on the bottom, the key to the economics is at $50, $60 WTI. We are paying out on both the 1 and the 1.5 mile wells. We're paying out in less than a year. And that's a big piece of our business, is those quick payouts. Great economics on this play. Pembina, we've come back to this play in the last year, and it's been an exciting piece of business for us as well. We've got in here about a year and a half ago, and we started drilling industry pace setting 1 mile horizontal wells as well. We got a lot of locations here. Our first 6 wells that we started drilling in Q4 of 19 are plotted in the graph here in the middle and on the left-hand side. The blue line is our type curve that we're using in our forecast. This is the results from these wells. And if you take a look at the 1 mile in our economics, we're estimating that the IP initial production over the first 365 days is 100 BOEs a day. These wells have averaged 143, so 43% better than what our type curve was. And that even includes, you can see here where you got these drops, that's curtailed production during the pandemic and the low oil prices. Again, on the economic side, we're drilling these wells, bringing them on, and the payouts are less than 1 year in the current commodity price. So again, really strong area. Now, with that said, we were really happy in October of last year to announce and to close a new acquisition in the Pembina area. We paid just under $2 million for this acquisition, and more normalized pricing in 2019, that's exactly 1 times net operating income. The third-party reserve evaluators at that time had PDP and proven reserves of about 1 million barrels. There's no undeveloped locations in there. So basically, we acquired it for less than $2 per producing barrel. Production about 240 barrels a day with a really low base decline because not a lot of activities happen here, about 10%. We acquired it for just under 8,000 a flowing barrel. Again, we can't add production or reserves on these metrics, so we'd love to do more of these type of opportunities. It's got a contiguous land base, which now allows us for extended reach horizontal wells in Pembina, so again, greater than 1 mile. We got 30 well drilling inventory, 23 classified as tier 1 that compete with our top-notch inventory. We circled over here on this northwest corner 3 wells, 2 horizontals going north-south and 1 east-west. These are 1 mile or less than 1 mile wells. Here's our type curve and the dashed line. Here's the 3 resulting wells all around us in that corner, with the best well on the north side doing somewhere near 400,000 barrels of oil is what it's going to accumulate. This is one of the best wells in Pembina. We've just finished our drilling program with 3 wells up here in that northwest corner, and they're currently being completed and should be on in the last 5 days or so of March. A little bit later than we expected, but pretty excited to get those wells on. So here's our drill times. In Williston Green, very consistent on the bottom here. We're drilling all these wells in 7.9 to about 10.8 days. Really tight consistency going on here. But our recent 3 well pads was 7.9 to 8.8 days. And you can, with all of that over the last couple of years, we've also been able to reduce our costs by about 25%. So these are about $2.4 million. You can see on the bottom here, our time against our peers, and you can see the InPlay logo here. And again, really solid. 2 of the wells fastest in the Williston Green area for extended reach wells, and 4 of the top 6 are ours, with 13 of the top 25 being InPlay in this chart. In Pembina, we just got back a year and a half ago back here, 4.1 to 4.8 days to drill here. Very consistent. Again, same thing, reduced drilling completion costs by about 25%. So technology and cost structures have gone down. The last 3 wells we drilled were the fastest ever drilled here. 5 of them in the top 9. Again, solid results showing the technical acumen of our team and our operational group. East Basin Duvernay. I'm not going to spend a lot of time talking about the East Basin Duvernay today. It's not getting a lot of capital at this point in time, but it's a good long-term play. Lots of oil in place. There's other private guys all around us that are working this play and doing a lot of the legwork, trying to figure out the best way to extract this at the most economic costs. With that said, the reason we're not here, it just doesn't match with the economics right now in the Cardium play. Still excited about this play. It's a long-term play, but nothing going on too much at this point in time. Okay. So we're back to our 2021 forecast. So WTI is down a little bit today, but the funny part is the back end of the curve hasn't gone down as much as the front part of the curve. But we got an average of $60.50 WTI. That gets us 71.50 Canadian with the effect with its exchange rate. Of course, we sell our product in US dollars. We talked about our production average for the year. Over that range, we get $39 to $42 million of adjusted funds flow, which is used to pay our capital program. It's used to pay our decommissioning, and it's used to pay down debt. That's that 15 to 18 million of free cash flow. Now, net debt to EBITDA here for the year is 1.3 to 1.5 times, and it's working its way to 1 times by the end of the year. That's 5 times less than what it's going to be in 2020. That's a remarkable turnaround. Now, Q3 to the end of the year, if WTI drops about $5, we lose about 3.3 million in funds flow. So we're hedged pretty good for the rest of this year. The worst of our hedges that we put in 2020 come off the books in June, and then we're hedged very strongly and smartly as we get into the second half of the year. Net asset value. Okay, so the net present value on a 10% basis, our PDP value is 95 million. Our undeveloped land's just under 50, and our debt at the end of the year. That gets us about $1.02 in net asset value per share. On a proven basis, that's $1.94 in 2020. And approved plus probable, or total approved plus probable, is $3.50. So when you take a look at those numbers, you know, I guess these are done on what I would call a conservative price deck that the reserve evaluators used. They changed the way they did it, and they're so conservative. You can see on the bottom how far they've dropped the prices for all the products over the first 3 years. But I think just as importantly, when they did this price deck, it was 34% below the first year WTI price, and I think it's 15% below the second year when they did this and when we announced our reserve. So again, I think the net asset value here is solid, and it's probably on a conservative basis. With that said, most of our analysts now have got us into that proved developed producing net asset value as their share price. So it tells you the value gap here. And secondly, I think over time we start working our way to that proved total proved number of $1.94. Now that occurs, and that's not even that far off, because when you start looking at Q3 and Q4 at $60 WTI, 3 to 4 times EV DAC F or cash flow multiples gets us into that range. So again, tells you the value opportunity that's here. So in summary, I mean, we're a very strong technical team. We've been managing through a challenging environment, obviously. We had an aggressive, active response to the COVID-19 pandemic, positioned ourselves for continued growth, top decile organic per share growth, light oil growth again, generating free funds flow of $15 to $18 million, as it's a word that everybody's using right now. We're financially strong. We're getting back to 1.3 to 1.5 times 2021 debt to EBITDA. We're positioned for more tuck-in acquisitions. We'll continue to do those all day long if those opportunity arrives, like we've been able to do. Of course, you've got significant torque to oil pricing. Our best-in-class operational and technical acumen, driving costs lower, exceeding production forecasts, you know, the strong capital efficiencies and reserve additions. As I mentioned, and I say it again, it's a key to the industry going forward, where the investors are demanding a return on capital employed, not growth for growth's sake. The access to capital isn't where it used to be. Again, how you spend your money, how efficient you are, is a key to success and thriving going forward. And I think as I've shown you, we're at the top of that group. With that, I'll end, and I'll let Campbell take over and start with questions.
Thank you, everyone who has already sent questions and comments in. Just email them or find your way to the chat or the question tabs on the floating GoToWebinar thing over there. You said you were reducing your draws on your line of credit. Did you mean you were paying down your line of credit?
Correct. We're paying down our reserve-based lending revolving line of credit. Yeah, we'll continue to lower that. I mean, our goal is to get us back down to below 1 times debt to EBITDA, debt to cash flow, you know, as quickly as possible.
Would you say that Biden's cancellation of Keystone had an effect on the business or future outlook, I guess, for the industry and for you in particular. But any comment on that? Wonderful.
Yeah, I mean, I think fair enough. Yeah, I think it was more of a gut shot right at this point in time. I mean, I think most people knew that it was coming. It's not like it has changed the pricing or the differentials at this point in time. We're light oil based. I mean, Keystone XL was going to be predominantly a heavy oil line. The interesting part about this is we're still not quite back to pre-COVID levels as a country, and the U.S. is the same at 11 million barrels compared to 13 million barrels. There is growth opportunity on the heavy oil side, and some of the heavy oil guys some of the companies have gotten back to pre-COVID levels. Plus, they were curtailed, mandated curtailments by the government, so they were able to get those back on. But on the light oil side, we're some 100,000 barrels off of our highs of the high 600,000 barrels. So we're not drilling enough to even maintain that production, never mind get back to those levels. So, I mean, the light oil business in Canada, looks pretty good. And I mean, the key with those pipelines is how it affects differentials. And differentials for the rest of this year are some of the lowest I've seen in a long time. And I think that's because of our lack of production. I mean, we do have Trans Mountain still moving forward, that has been funded by the federal government. And I mean, in many circles, there's talk that, if we don't grow our production in Canada, as what was predicted a long time ago, you're already seeing less rail, crude by rail right now. But if we don't grow our production, we might have excess pipeline capacity. And you could actually see our differentials that are typically negative to discount to WTI could become a positive. So again, not a great outcome. Honestly, I think it hurts the U.S. just about more than it hurts us, because they need heavy crudes for those refineries in the Chicago area, and specifically down in the Gulf Coast. And if they're not getting it from Canada, where are they getting it from? Venezuela, maybe a little bit from Mexico, and then you're going further to get those crudes that are required in those upgraders.
You're given 2021 operating expense guidance of 1150 to 1350 BOE, which is significantly below recent quarter numbers. What makes you confident costs will continue to decline?
So again, I think we had discounts of up to 25% in operating costs, and a lot from our service providers last year. So some of that's starting to come back. So we estimate there's about 10% more that's going to, there's about 10% that'll stay with us. We're starting to see a little bit of cost pressures in the first quarter. But again, that's always our most active quarter in Canada as well. So I think, the first quarter will be a little bit higher, and then you'll start seeing it come down as we go forward. We've changed some of the operations as well, and how we drill, complete, equip, and tie in these wells. And some of those, the results from that are actually getting us lower operating costs right from the start of these operations as well. So those are the keys of what's going on there. And again, just being in a focused area, we're very focused on our operations and production base, and that all helps.
Excellent. Thank you again for the questions getting sent in. And by the way, you can download a copy of this PDF if you find your way to the control panel. Again, it says handouts, and easy way to get it while you're listening. Can you speak to financial flexibility, Doug? What would be plans if WTI goes up or down 20%, debt repayment, drilling, production, etc.?
Yeah, and that's a great question. I mean, we are going to be flexible with all of that. We're sitting here with, again, we've got all our disclosure there, sensitivities to WTI price. We're not going to change that quickly. I mean, if price of oil goes up, we have the opportunity to increase capital spending in our drilling program some. But again, debt repayment, getting to, it's a balance between getting down to that 1x debt level, debt to cash flow level, growth. Again, if I have good free cash flow, I would love to keep doing some of these tuck-in acquisitions if the cost structures remain anywhere near they have been. So again, it'll be flexibility, a combination of many of these things on how we manage all of that. We're not going to make quick decisions. And you're kind of seeing that across the industry, the discipline that everybody's showing right now. it's no longer growth for growth's sake. The investors are demanding return on capital employed, and that's what you're seeing. Whether it's Canada, the United States. Of course, free cash flow is the new buzzword right now. I mean, we all added debt in 2020, and the majority of us added debt, and we got to get back to normal. I mean, the other piece of that, why you don't see a lot of activity happening is a lot of guys are hedged this year, specifically like us through the first half of the year, and that's reducing your funds flow in the first half of the year. Again, keeping everybody sort of on a conservative level right now.
Pat, I'm going to pass it to Stu for a moment. He's got some questions of his own.
Yeah, thanks for the presentation, Doug. And whilst on hedging, how do you guys approach your hedging strategy, and how much of your production, do you ideally want to hedge, and over what type of time period?
Yeah, I mean, we're generally short-term hedgers, like maximum up to a year out. That's been our strategy for a while. I mean, after last year, you'll start seeing us be more consistent with hedging. And we're probably, we're looking at about 50% of our production being hedged at least 6 to 9 months out. And if the opportunity arises, we'll hedge even more. I think with the backwardation on the curve at the highest prices, it was more difficult to hedge too far out. But we've been able to do some decent hedges in the second half of the year, and we're just starting to add some into 2022 as well. But generally, we think there's enough opportunities to do those shorter term hedges, and we're quite, we're generally bullish on the commodity cycle and the oil cycle. We've been somewhat late. I think it's gotten up to over $60 a little quicker than we probably would have imagined, like most guys. But I've got the oil and gas isn't going anywhere, whether some people would like to see that or not. I mean, just over the last few days, India just said they're going to double their oil and gas, their oil requirements from 4.3, I believe, to 8.7 million barrels by 2030. So, it's looking pretty interesting, and there's not enough capital going into the ground, and the access to capital is much more difficult. So again, we're relatively bullish. That's why we think we have those opportunities and we can do those short-term hedges.
Yeah, makes sense. And what factors is that kind of operational management, or is it a requirement from the debt providers as well to have some hedging in place?
Yeah, I mean, I think the key is to make sure you lock in the capital program. Get your pricing scenarios for that capital program, and so you can get those payouts. Get all your flush production and make sure you get a good price. Basically, again, I think you're seeing it more after last year and the volatility we had since 2000 and end of 2014, but specifically after last year, we're sitting here and the banks have not mandated it, but they encourage it, and we're getting the same from the board of directors as well. So that's how we view it.
Yep, makes sense. Your finding, development, and acquisition costs are quite low. If you could touch on that and how you guys get them so low compared to peers. What makes different for you guys?
Great question. I mean, we've been consistent. The last 3 years have been solid for us. Now, with that said, I mean, we're just getting a little sunburst here. The acquisitions were done at costs that I can add through the drill bit, so that's been a good piece of the business. But we don't do acquisitions just to keep low finding costs. I mean, that acquisition we did is going to be a big part of what we do going forward, specifically on the drilling front, which again we started, within 5 months we started drilling on that property. So again, that's a good part of it. We know our area. We know our business. That technical acumen doesn't stop at the drilling level, the completions level, and the operations level. I think on the exploitation level, we know what we like. We know what the pricing is. We have a good relationship with our lenders. We were able to tuck that in without any dilution. I mean, some guys did deals, but they had to dilute a lot. We were able to do it without dilution, which in turn is going to provide, I think, really long-term value for us and our shareholders.
Yeah, and then the strategy of picking up some of these, stranded or distressed assets, you obviously have some competitions. What would set you apart from vendors to, go with you guys versus others? Because you must have a fair bit of competition in some of these processes.
Yeah, no, we do. We do, but again, it's been less and less. There's actually less companies looking. There's less companies that actually have access to capital, whether it's the lending side or the equity side. There's very few that have accessed it, even though lately there's been a little bit more, but it's been slow to come back. Specifically on the Canadian oil and gas side. So, you got to know the environment. You got to know, generally who potentially your bidders are. It's quite a smaller market here in Canada. There's less guys going after light oil. So you put all those pieces together, and that's how we get some of these things done.
Yep. Okay. And then you mentioned earlier in the presentation about analyst coverage. How many analysts do you have covering you?
I think we got about a half a dozen covering us. Scott has access to those guys or to that information. And they're, generally the targets I think are now between about 75 cents would be the lowest and $1.20 the highest. So again, kind of in that PDP NAV, which in my mind is still low. And typically over time, like we should be trading closer to some sort of close ratio to a proven NAV. I mean, not too long ago, we used to trade at proof less probable NAVs, and that's dropped significantly. Cash flow multiples have dropped significantly as well, but it should work our way into that proved NAV at some point in time.
Yeah, I mean, half a dozen analysts covering a 35 mil market cap is pretty good. A very solid effort. So yeah, it's good.
Yeah, no, it's been interesting, and we had a few disappear. I mean, a lot of the banks have reduced their analysts and lost analysts and haven't replaced them. Of course, they weren't not making enough money on this side of the business, but you're starting to see a little more interest, more guys coming back.
Yeah, and how capital intensive are the areas you're producing now, and where do you see your capex intensity changing in the future?
So again, strong focus on the Cardium. If I guess like this year, it's 90+% of our capital program. If we get in, we continue with a $60 WTI price or better going into 2022. Our debt's down to 1x. I think you'll start seeing us put some money back into the Duvernay play and start drilling there. We got some great ideas on cost reductions that we've learned from the Cardium that we'd like to take over to that play. And some of the technology. So, but again, I think that's a 2020 opportunity. But again, just stay focused on the Cardium, hit our targets, and go from there.
And how much did you pay for Cardium again?
Sorry, say that again.
The acquisition costs of the Cardium.
It was about $2 million.
Yeah. Okay. Gotcha. And then out of your operations, which operation has the highest profit margin and why?
So I would say Pembina is now working its way into the highest profit margin, and Willie Green has been there for a couple of years. And I think a lot of it really sort of does depend on the activity. So the activity level in the prior few years has been 60-70% in the Willie Green. So when you're drilling the new wells, that's when you got the highest profit margins during that flush production. You got the lowest operating costs. Most of our wells are Crown royalty, so Alberta government royalty based, and there's an incentive in place where we only pay 5% royalties for the first, anywhere from 2 to 3 years. So you compare that against most of the shale plays in the United States and the Permian and stuff. Like these guys are freehold royalties, paying mineral right holders 22% plus a state tax, like upwards of 25% for the life of the well. So we're getting 5% for the first 2-3 years. So again. That's where you see that. So again, that activity is what really drives the highest profit margin areas.
Right. Thank you, Artie.
Thank you. I'm wondering how much did you spend for how much capital you spent for the development in 2020, and how many wells you are bringing into production this year?
So let me just in 2020, you're asking the capital program in 2020? So it ended at about $23 million. We drilled 4 wells in the first quarter, cut it all off, and then we drilled 3 wells late in the year, which in turn those 3 wells came on the last week of December. So they didn't really add a lot of production to 2020. Now, with that said, we also had a non-op well, about 20% non-op well that was drilled and brought on here in February of this year. Now, with that said, we're sitting there drilling about 8 wells this year and bringing 8 wells on as it stands right now, with 3 of them being in the first quarter here. They've been drilled. We're actually in the final stages of completion, and they should be on by the end of the week. So they'll get 4 or 5 days of production in the first quarter, but you'll see most of that production being through the second quarter.
When we look at the production rates generally, what are some operational challenges in your area that can affect the production rates?
I mean, the biggest thing on production rates, again, you want to make sure you get solid completions off, which again we have. We've been leading the technology charge in the Cardium, trying different things. We've landed on a really good piece or type of operation. If you get those good completions, you get good flush production. You have very, very low op costs from the beginning and the life of the well. With very little downtime. Those are the pieces. Our second quarter, of course, in Canada can be, interesting. We're frozen in the first quarter. That's why you have the highest activity with drilling, specifically in winter-only access areas. Where we are, we have kind of year-round access, but there's a time in the second quarter where it's difficult to do operations. And if it's a really rainy, cold spring as the frost coming out of the ground, it could be difficult to move fluid, move oil, and move water over a course of the second quarter. So that causes some problems. Otherwise, nothing too complicated with what we're doing there.
Thank you, Campbell.
We have a few more questions that have been sent in, and then we'll close. Thank you, everyone, for sending them in and showing up and paying attention. So you've added hedges as prices, but not added any oil hedges beyond June. I guess we've covered hedges a little bit, but what is your appetite to lock in prices at current levels? So asking it in a different way.
Yeah, so we are hedged second half of the year, close to 50% now, Campbell. So the hedges that were put in mostly in 2020 are coming off in June, so we're hedged in. As I mentioned prior, I think Stuart asked, we're typically 9 months to a year out is what we're hedging. With the backwardation, we haven't been going too far out. We're relatively bullish on we're quite bullish on the pricing. Whether that pricing, goes up to $70, $80, that's actually not what I would like to see. But if it stayed consistently in that $65 range, would be a perfect piece of business, and we could run a great company. And we would hedge, probably put collars in all day long in that range. With the backwardation, we're hedging a little bit less, but not too far out. But again, it's kind of like today when you got a drop in the front end, you haven't seen the same amount of drop on the back end. We're actually probably flat compared to what we were a little while ago when we had backwardation going out past a quarter or two. So we'll continue to layer them in, specifically as we sit today, and specifically until we get our debt to cash flow down below 1x, I would say.
You didn't raise your capital expenditure budget when you raised cash flow productions. Does that mean you have a preference to use excess cash flow to pay down debt over expanding resources?
So yeah, good question. Again, I think very flexible with that. With our history, if commodity prices hold, we kind of got a set program through the end of Q2. Again, Q2, we don't do a lot of drilling in Q2 due to the breakup, and it can be costlier to do drilling. So we're kind of set until the end of Q2, which in turn, we have another, board meeting and a press release for our Q2 numbers in early August. And that tends to be the time, if commodity prices are holding, where we might take the opportunity to spend a little bit more on capital and potentially increase guidance or change guidance at that time. But you won't see a ton of that until probably August, and a little bit more certainty on what the commodity prices do. But that could easily happen where we add a little bit more to drilling and balance it with that and paying down debt.
When do you expect or desire to turn a profit?
Well, I mean, you know what? As it stands right now, you would see profitable income this year. So it's very commodity based. It's all about the price of the product right now. So yeah, we actually have had quarters where we've shown positive income. So that's how we look at that, or how we see that.
Had some great questions. Before we close, if you have anything to say regarding your crystal ball on oil prices, what do you hear in Calgary? And given everything is so commodity dependent, and then we'll close. So give us your thoughts. Yeah. What's your thesis?
Yeah, again, I think I talked about it a little bit in bits and pieces, but again, I think we're moderately bullish, or well, not moderately, we're quite bullish. Again, I mean, I'm not a fan of $70, $80 oil. It causes a lot of problems. It causes problems with demand destruction. It causes problems. The service industry has been decimated a little bit. You get to $70, $80, you're going to see service industries have a tough time getting people back on a reasonable time frame. I think gradual, smart price increases, you can manage through that. And then just specifically, our industry's changed. And again, we got lots of headwinds, the environmental side of it. More importantly, you've got the demand by Wall Street, by Bay Street, by investors to show return on capital employed and not growth for growth's sake. And that's what happened. Like when you take a look, when the U.S. went from, there were 9 million barrels, I think, in 2014, and then through 15 and 16 went down to 8, and then just massive growth to 13 million barrels, spending 3, 4, 5 times cash flow over, or capital over cash flow, because there was easy access to capital and debt. I don't see that occurring again. So you need to live within your means a bit better. You need to be efficient in how you spend your money, and that's what the investors are demanding. So like I say, our industry's fundamentally changed, and you got to be at the top of your game and the top of the peer group. And for us, I think that's shown over time, and there's less and less small companies out here, and we're torquey. We're very torquey to what's going on here, and the investors haven't come down cap at this point in time, and they are. They typically go large cap. They go where the liquidity is there, especially the funds, and then they slowly work their ways to the intermediates, and they slowly work their ways to the smaller caps. I think you're seeing that moving into the intermediate caps right now. So this is a great time, I think, for the retail investor to take a good hard look, because once some funds start moving down cap, that's when you'll start seeing some pretty strong appreciation.
Excellent. The replay will be available at amvestcapital.com/webinars in about an hour. Just let it process and bake. You can get the copy of this presentation and the handouts thing here, or email me, and perhaps it'll be on the InPlay Oil website in not too distant future. With that, we're going to close. So Doug, I'm going to give it to you to close, and I'm speaking for both of us. We would love all your feedback. So when you ask for what you think, and as InPlay as an investment, please give us a response. So Doug will get it pretty almost instantaneously. Doug, all you.
Yeah. No, it's been a pleasure. Again, getting on here first time after we released our year-end results. Mm-hmm. And again, we're open. I think all of our information is on the back of this presentation. Feel free to reach out and ask us any questions. It's going to be an exciting year for us. The change is dramatic, and it's quite remarkable from where we were a year ago. And I believe going forward in the next 5 to 10 years, we're still in a pretty good position. I mean, there'll be some volatility, But in general, contrary to the belief, I don't think oil demand is dropping to nothing anytime soon. So, just the way the industry is, we're in a good spot. So, I look forward to continue to present to everybody and getting out there. So reach out with any questions, and it's been a pleasure.
Thank you, Doug, and thank you, Scott Koyach. Good day, everybody. Cheers.
Thanks, guys.